Hi, this is Lance Edwards, and I want to welcome you to this edition of Apartment Wealth Nuggets. And the question we're going to address today is the question I hear a lot: should I wait for the economy to get started? Should I wait? So I hear this quite a bit, so we're going to address it right now in this Nugget session. And so this whole question about should I wait, I really equate it to, and I understand it because I've had these same thoughts myself. And having done this for a couple of decades, let me give you my perspective, because the best analogy I could give in should I wait is like, should I wait for all the green lights to turn green before I start down this road? Because that's really what we're asking ourselves. We're trying to predict the future, and because since we can never predict the future, we end up stymied, we end up stuck. And we're in this proverbial paralysis by analysis. And so I think waiting is the last thing you should do. Waiting for all the green lights to turn green is never going to work. So we're going to address that in this session today. We'll talk about the two uncertainties that people are talking about so much in the economy now, that the media likes to talk about. One of them is inflation, and the other is recession. Let's talk about them both. So first, inflation. It's in the news. And I just went and pulled some random headlines off the internet and about inflation. And what it says is this: multifamily real estate might be the ultimate inflation hedge. Apartments prove themselves among the best assets to protect investors against high inflation. Apartments' flexibility provide inflation hedge. Apartments are the number one inflation hedge. It's not something that just happened. It's always been the case. We're going to go over these reasons in just a moment, but this is, income producing real estate is a classic inflation hedge. Matter of fact, this subheadline on this last headline that I'm sharing with you, I'm going to read it, kind of small font. It says, with shorter leases, multifamily owners can adjust accordingly if prices rise. We operate these apartments. These are businesses, just like any businesses. When our costs go up, we raise our prices. It's the same thing that we're doing. We are raising our rents. We can raise rents through these apartment buildings. So let's just look at the math. If we raise the rent $100 per month across our apartment, what's that mean to us? Well, it means an extra $1,200 a year cash flow per door increase. All right, so assuming the expenses are fixed, that's a $1,200 cash flow per door increase. On an equity basis, it's $16,000 equity per door increase. Take the NOI, divide it by 6% cap rate, that's what you get. $16,000 per door increase in equity when we raise rents. So we can raise rents to stay ahead of inflation. We can keep our cash flow ahead of inflation. We can keep our equity and our net worth growth ahead of inflation. Now let me just break it down. Let's do a few quick math exercises here. If you have 5 doors and you just raise the rent $100, you've raised your cash flow $6,000 per year. Your equity's gone up $80,000 just by the decision to raise your rent $100. Let's add a zero to it. 50 doors, that's $60,000 cash flow increase plus $800,000 equity increase. This is on top of the equity you already have. And of course, 100 doors, it's $120,000 a year cash flow increase, $1.6 million equity increase. This is why apartments, or more specifically, income producing real estate like apartments, is the classic inflation hedge. So you need to be buying apartments to stay ahead of inflation, which is what I'm doing. I'm out buying apartments. Let me give you an example. This is a project I recently did. This was referred to me by one of our students, Diana Donert. She lives in San Diego, found this property on the internet in Oklahoma City, more specifically Moore, Oklahoma, 56 units, 91% occupied. She green-lighted the deal, and she sent it to me. I took over from there. I bought it, paid her a $25,000 finder fee. I'm about to show you how much I'm going to make on this project. You'll see $25,000 finder fee is a drop in the bucket. Now that plaque I'm showing you right there, that's actually a plaque we've hung acknowledging Diana's contribution. That's on the actual apartment project. All right, so I partnered with her on this project. I bought it. We had our grand opening. There's just some members of my network. Just a few of my investors actually flew to Oklahoma to be part of the grand opening. That was our 90-day grand opening. There's the Chamber of Commerce. There's others there. There's some members of the management team. We had this property at this point for 90 days. Now, I talked about, give you an example of raising the rent $100. In the first 90 days, we've raised rent $200. $200 on this project alone. I have another project, we've raised the rents $250 over the last 12 months. So I already showed you the power of a $100 rent increase. I just doubled it here. I'm buying these because this is where besides parking my investors' cash, I'm also parking my cash here to stay ahead of inflation. So if you have your own cash to put in these deals, just recognize that every time, as long as it sits in cash, it's going down in value every single day. You need to put it into your own apartment projects and stay ahead of inflation and leverage the #1 inflation hedge. And you especially want to do it on mom and pop small apartments, because the reason I could get a $200 rent bump on this project in just the first 90 days is because mom and pop operators typically never raise the rents. They don't like to raise the rents. They don't like to add other income. All the things that we're doing in this property right now to what I call potentialize it, to raise the value, is to stay ahead of inflation and to create cash flow and equity for me and my wife. And that's why you get involved with apartments, to do those things, but now you can use it as a #1 inflation hedge. And as a matter of fact, I'm going to give you a pretty controversial statement. As apartment owners, we welcome inflation. Apartment owners welcome inflation. Well, how can that be, Lance? Who welcomes inflation? Here's why. Because on this project, when I bought it, I have fixed rate debt. My interest rate is fixed. All right, so I have a fixed interest rate. That means my mortgage payment doesn't go up and my mortgage balance doesn't go up. Think about it. In inflation, everything is increasing in value. All my costs are going up. Everything's inflating in value except for debt. Debt does not go up. My mortgage balance doesn't go up because there's inflation. My mortgage payment doesn't go up because there's inflation, because I use fixed debt with fixed rates. So what that means is, as I'm raising my rents to accommodate inflation, my cash flow is going up because my mortgage payment is fixed, and my equity is going up because my mortgage payment is also fixed. Matter of fact, my mortgage payment is going down every month because my renters are paying it down for me. And when I do pay my mortgage, that fixed mortgage, I'm paying it in the future in cheaper dollars. The dollars I'm using to pay down my mortgage are actually cheaper 1 year from now, 2 years from now, 3 years from now than they are today. So I'm actually, the mortgage is getting cheaper and cheaper for me. That's why apartment owners love inflation. You're making money on both sides of the balance sheet. So here's the rule in inflation. Buy apartments, #1, that's the rule. Buy apartments, and then what you do is you want to make sure you have short leases and long debt. Short leases and long debt. On that project I just showed you, I've shrunk it. We had fixed leases at 12 months. We're now reducing those to 6 months. Why would I do that? Because I want the flexibility and the latitude to raise rents more often than once every 12 months. I've got another project where we're on month to month. We're staying month to month because I have the total latitude to raise rents as we need to, as inflation does whatever it's going to do. So there's the rule. Get involved, buy apartments, buy onto them, have short leases, long debt. The longer the debt, the better. All right, so that's inflation. That's my case why you need buying in inflation. Let's talk about the other economic uncertainty, the R word, recession. We hear that in the news. Okay, a lot of people want to freeze up. What if a recession comes? What if? So let's just look at the facts. Let's look at the facts. Of course, none of us can predict the future, but just look at the facts. What we do know, we can't predict the future, so just sitting still and waiting for all the green lights to occur is never going to occur. But let's look at the facts historically. This is going back 60 years. Federal Reserve Bank of St. Louis. They put out this chart which shows residential real estate values over the last 60 years, going back to 1962. Now, these gray bars, every one of these gray bars represent a recessionary period. And if you look at this, let's break it down. Let's go back to 1970. 1970, you can see during that recession, first of all, real estate was not increasing very much at all. It had a slight dip, if anything. Mostly it was flat, and then it started going up. Okay? So if you had not gotten involved, you would have missed the upturn. And how can you predict when the right time to get involved is anyway? Let's look here, 1975. Look at real estate values went up through that recession in 1975. They kept going up. 1980, they kept going up. In the early 80s, they kept going up through recession. Real estate values are going up. Look at 1990. 1990 had a small blip, then it went flat. Within a year, it popped back up again. All right? That's the effect of recession. Let's look here at early 2000. Had a very short temporary blip. Prices bounced back up again. They kept heading up. They kept heading up. The only time that we see any appreciable decline in real estate values is right here in 2008. Remember what happened in 2008? It was a subprime fiasco. had the mortgage crisis. We had the financial crisis. It was almost financial Armageddon for the planet. And we saw prices go down. That was not because of the recession. There was a recession that resulted because of all that disruption. But the reason prices went down, as showing in that chart, as you recall back in 2008, no one could get a mortgage. And because no one could get a mortgage, in order for apartment owners to sell, they dumped their prices. So we had this broken system. It wasn't fundamentals of recession. It was just a broken system driven by greed of people selling subprime debt and mortgages. That's what broke the system. And we saw, yes, we had a price decrease in 2008, and then it came back a couple of years later, and look what it's been doing ever since. So you can see that during these recessionary periods, values either have a short dip, or they're flat, or they keep on moving. But you want to be involved with apartments because you want to be able to ride the inflation that's going along. Keep raising the rents, keep raising the occupancy, as we've just been talking about. All right, and remember, housing is always a basic need. This is not some luxury. This is a basic need we have. So what do we do to be smart about picking the projects we're going to do in a recession? Okay, so that is the question. Well, how can we be smart about picking these projects? Now, remember, what I told you is I don't want you to be looking for all the lights to turn green. There's only one light you need to turn green, and that's your deal. You need to green light your deals. That's the vernacular, that's the language we use when we're screening our deals. We have a green light software. It's either red light, you don't do it, green light, you do it. So the only green light I want you looking for right now is green light deals. And that's the projects you want to be involved in. Now, what makes a project a green light deal? Cash flow. Cash flow. That's what's built into our green light software. There's a heavy weighting towards cash flow, and then the overall ROI. We are simultaneously looking at 3 different tests to satisfy on these projects. Cash flow means we can make the mortgage payments. Cash flow means these projects can ride through any disruption. Because as long as a project can cash flow, the values blipping up and down really doesn't matter. Cash flow is king. That's how in any economy, that's how we screen these properties. And that's what's even more heavy if you're concerned about inflation. That's what we're doing now with our Greenlight software. The other thing we're doing, and what you want to do during a recession, is you want to target working class housing. This is Class B and C properties. Class A is going to be the first to get hit. The luxury housing, the really nice stuff, if there is indeed a recession, that's the first to get hit. And those people living in Class A properties are going to move into B's, B's are going to move into C's. So you want to be in the workforce housing, Class B and C assets, which is the biggest preponderance of those are across the country. And of course, you never get into D's. You don't want the war zone stuff. And then the final thing we're doing, if you can think there's a recession coming, is you choose recession-resistant markets. Now, what are those? Those are the markets that have multiple industries serving them. They're not tied to one particular industry, because if something happens to that one industry that affects jobs, that affects people's ability to pay rent. So you want a diversification of industries as you're choosing recession-resistant markets. This is how we be smart in acquiring and buying these apartments so that, number one, we can beat inflation and we can ride through whatever blip or disruption we might have with recession. So the bottom line, get started. Don't wait for all the green lights to turn green. They're never going to do that. You're going to miss out on the opportunities. You're going to get all beat up over inflation. You're going to see your cash get destroyed. And remember, you're just one deal away. That one deal away could be the one that sets you going forward. For me, years ago, was that first fourplex. That first fourplex set me on my path, established my confidence, and I never looked back. You're just one deal away right now. Don't hesitate. Don't look for every green light to turn green. Just find the one green light deal and get started right there. And if you'd like to investigate working with me and my deal-making team and my Wealth Mastermind network of resources who are here to support you in these projects, the ones that I've already vetted out for you, and leveraging all those resources and getting started right now, then I'll invite you to click the link below and take you another page and explain how you can be working with me and my team and just get started. Until we have the opportunity to work together, I look forward to meeting you.